So the big change, and really where we're going to focus the rest of our webinar today, is that the federal estate tax exemption is going to have a pretty significant decrease of what you're allowed to take advantage of today versus tomorrow. So when we think about basic estate tax planning, you think about having a will, and believe it or not, over 68% of Americans don't have a will or an updated will. Their wills are out of date or they don't have one at all. So that's pretty surprising. Trust planning, it could be simple trust, right? It doesn't have to be a complicated trust. So definitely taking advantage of trust to make sure your assets are left to the right people at the right time will make sense. Durable powers of attorney. This is a legal document that allows someone to step into your shoes financially and make financial decisions on your behalf if you're incapable of doing so. If they are a durable power, they can do it at any point. You don't have to necessarily be incapacitated or unable to make those decisions. There's many different types and variations of those powers of attorney. A living will or healthcare directive. So you could give a health proxy to a loved one or someone that you trust to help make health care decisions on your behalf if you're incapacitated. And then, believe it or not, beneficiary designations. I'm in the insurance industry here as the director of insurance. We see a lot of old life insurance policies that have the wrong beneficiaries named on them. Could be ex-spouses, could be an old business partner, could be children that maybe you don't talk to, or maybe it's children that you've added to your family and you haven't thought about all the children that you now have, maybe from a second marriage or having children later in life. So there's definitely reasons to review all things that have a beneficiary tied to them, and also to note that anything that has a beneficiary designation passes outside of probate and your will. So that's important to note, because they'll pay whoever's named on that policy, whether it's an ex-spouse or not. And then getting into the more advanced estate planning, especially when there's an estate tax to be considered. So in 2017, our individual exemption amount was about $5.49 million. And in 2024, that's at $13.6 million. So as a couple today, you could protect or shield over $27 million of your assets from the federal estate tax. So if you passed away today with $27 million, you wouldn't owe any taxes to the federal government for estate taxes. In 2026, that'll revert back to an inflation-adjusted around $7 million. So that $5.49 million over the last 9 years will adjust to about $7 million is what we're anticipating. So as a couple, you'll only be able to exempt $14 million of assets. So it's cutting your exemption pretty much in half from where it is today. And so we want to really make sure that we're taking advantage of that exemption in a way that, when I show you kind of this example, if you're a married couple with $20 million of assets today and you passed away, you would owe no taxes. There would be no taxes owed. But if you passed away in 2 years from now, in 2026 or later, you would now owe over $2.4 million, just simply because of that exemption coming down or being cut in half. So there is a cost of waiting. There is a cost of not doing much in planning. So we're encouraging everyone to start thinking about planning on a larger scale, especially if you're in that high net worth bracket. But for anyone should be doing estate planning, making sure your wills are up to date, you have the proper legal documents in place. And from here, I'll pass it along to Kate so she could go into more of the planning techniques around the federal estate tax.
So first, I'm going to talk about kind of the different groups of people who might be affected by the reduction in the estate tax exemption amount. So first, there are those of you who are already subject to estate taxes. So those for individuals, your estate is over around 14 million. And for a married couple, you're slightly over 27 million. So you are going to pay an estate tax even if you both died today. So we're hoping that you've already done at least some basic planning, because just to at least help avoid current estate taxes, but you may want to go into more detail or do more things to help lock in those higher exemption amounts today before they drop. The people we're probably most worried about are those who are currently not subject to estate taxes, but will be in 2 years. So if you're an individual, you're somebody with an estate between about 7 and 13 million, or if you're married, your total estate is between about $14 and $27 million. So those of you in that bracket, we're thinking if you've done planning, it's probably been a lot more simplistic because you haven't had to worry about estate taxes. Going forward in a couple of years, if you don't do any planning right now to help either lock in the exemption, take gifting, do anything in basic planning, you might be increasing your estate tax liability in 2026 and beyond. And then there are those of you who probably aren't subject to estate taxes now, but you're high earners, and you're likely sometime in the future going to be subject to those taxes. So you probably don't need to act right away. There might be some things you might want to do to take advantage of today's laws before they drop, but if you don't do anything, you're not going to be in as bad of a situation as those first two groups who are going to be subject, who are either currently subject or going to be subject to estate taxes. So that's for people, individuals are making, over $300,000 a year. You already have about $1 million in investable assets or more. Married couples, we're thinking of you more like $500,000 a year with $2 million investable assets. Something this particular group of people will need to worry more about is if you live in a state with an estate tax or inheritance tax. So I'm from Minnesota. You're going to be subject to estate taxes in Minnesota here with an estate over $3 million. If you live in Oregon, your estate only has to exceed $1 million before you're subject to state estate taxes. So while you might not need to act to help avoid federal estate taxes, you might need to be doing something to make sure you're avoiding those state estate and inheritance taxes. And then there's that other unknown group. So you're the ones who have hard to evaluate assets. So you're business owners. It's a very illiquid asset, but most of your estate is in that. You don't know exactly what it's worth. And if you're to die and were subject to estate taxes, you wouldn't have the liquidity to pay those taxes. Same with real estate. That's a little bit harder to value. And it's also very hard to liquidate quickly if you need to pay estate taxes. And then those of you who are blended families, you're less likely to be able to kind of move your assets around because you want to make sure that your assets go to your kids, even though you're taking care of your spouse if you're to die first. And then something not on that list is also people who have non-US citizen spouses. There's probably some additional planning you need to do there because of the treatment of what we call the unlimited marital deduction.